From the Land Grant University in Urbana-Champaign, Illinois, this is the closing market report for the second day of March 2026. I'm Extension's Todd Gleason, coming to you today from the iHotel and the Landowners Conference. Coming up, we'll hear from Curt Kimmel, agmarket.net, about the marketplace and how it has reacted to the developments in the Mideast over the weekend. Jonathan Coppess, Ag Policy Specialist, will join us to discuss the CRP, or Conservation Reserve Program, and its potential use in the Farm Bill and development as a further tool to help farmers maintain prices across the United States. And then we'll turn our attention, of course, to the weather with Mark Russo of EverStream Analytics, and Ed Usset will be here too from University of Minnesota to discuss the marketplace on this Monday edition of the Closing Market Report from Illinois Public Media. Curt Kimmel from agmarket.net now joins us to take a look at the marketplace. Hi, Curt. Thanks for taking some time with me today. Made for an interesting weekend with the developments in Iran. Did it have much of an impact on the commodity markets overnight and into today's trade?
Mainly the energy sector and outside market sector for the most part. U.S. crude oil prices started out with a surge, $6 to $8 higher. As we record this, the market has calmed down somewhat with the crude oil up about $3.50, $4 a barrel. The main concern there, of course, is the transportation through the Mideast. And I don't know if any oil-producing facilities have been hit for the most part, but that's where most risk on is. When you look back in past history during the Gulf conflict, Iraq, Kuwait, most of the premium was priced in the marketplace fairly early. So I don't know if we've done that yet or not, or still have some more or so-called another shoe to fall yet. But most of the world is watching the transportation through the Middle East. It's come to a complete halt. I believe just about everybody knows somebody that knows somebody that's been stranded on travel, and of course most of the ships are at foot. As far as the grains go, initially the concern is China. China is a big buyer of Iranian oil, as you know. So what's going to happen from that? The market's taking it fairly well as we enter the last part of the session with the old beans down 5, new beans up 0.5 cent. More bear spreading, uncertainty on future demand of old crop. Then lastly, too, the little up in early opening trade was met with the market reaching up the upper end of the trading range. If you draw a downtrend line on the corn chart, we're there, and on the bean chart there we've got kind of a double top, so we've met some upside objectives, and it might be time here to consolidate until we get a better handle on who's doing what around the world.
On the other side of this, some of the fundamentals in the marketplace, what are you watching? For instance, the size of the crop in South America, acreage, and any kinds of predictions that might be coming out for the March report, those sorts of things?
Yeah, we got a lot of information or news or moving parts in front of it. The Southern Hemisphere continues to chug right along. Not a whole lot of news out of the Southern Hemisphere as far as yield goes, so it kind of tells me it's fairly good. Usually you hear if it's not up to expectations. The key is those beans have been anticipated. They're coming out in a timely fashion. Now we're going to start to focus on the weather forecast for that Safrinha crop. We'll have the weather guys watching 2 hemispheres. They'll be watching the Southern Hemisphere for that. Then they'll be watching the Northern Hemisphere as we see how this weather unfolds here in the next few days, because it's extremely dry out there. As far as the future expectations here, I think if you stop by the beef house Tuesday morning, you'll get a full round of information on what most analysts are looking for as we move forward here, Todd.
I will make note of 2 things. You and I are talking early today because I am hosting the Landowners Conference on campus at the iHotel here at the University of Illinois. And then tomorrow, of course, you will be at the Beef House along with a bevy of the rest of our analysts, parts of the farmdoc team as well. The registration links for that went down over the weekend, so I left the price tag just the same as it was. No hike going into it. So if you want to come, walk-ins are welcome, of course, but it's easier if you just fill out the registration form and pay before you come, because that's what's going to happen when you get to the Beef House. Doors open tomorrow at 7:30 a.m. And the program starts an hour later at 8:30. Those are Central times. It's 8:30 and 9:30 if you're in the Eastern time zone in Indiana. And we're sure looking forward to having you there, Curt, on the corn panel in the afternoon. It should be just a fantastic day. The Beef House is always a great day.
Oh, yeah. It's always great to be able to visit with everyone one-on-one. And, two, you got a great lineup. A lot of the analysts have some great ideas on how to kind of handle this risk premium we're starting to see increase as we move into the new crop planting season here. And I'm sure it's going to be another good event, even though it might rain a little bit.
Indeed, it's might rain just a little bit. That's fine. It should be a great day. Hey, and look forward to having you there, and thank you so much.
You bet. See you on Tuesday.
Curt Kimmel is with agmarket.net. He joins us here on the Closing Market Report on this Monday. You can see him tomorrow at the Beef House in Covington, Indiana, but go to your website at willag.org and register today. We'll see you tomorrow. I'm University of Illinois Extension's Todd Gleason. We're now joined by Jonathan Coppess, Agricultural Policy Specialist and member of the FarmDoc team here on the Urbana-Champaign campus of the University of Illinois, to talk about an article that he's written for the FarmDoc Daily website. This one is titled, "Now Would Seem Like a Good Time to Think Seriously About the CRP." That stands for the Conservation Reserve Program. I want to know why you wrote the article. Why is now a good time to think about CRP?
Well, I think the shortest and simplest answer, Todd, is I am concerned about where things are going for farmers in the ag economy. I'm concerned about, some of the lessons from history we may be missing and inadvertently recycling. And so CRP, the Conservation Reserve Program, is kind of our backbone, our foundational conservation program. And it was enacted in 1985 in the depths of the 80s farm and soil erosion crises. And it is a critical program. It was not reauthorized in the reconciliation bill last year, so it's in a state of uncertainty. It is reauthorized, but there's been no changes to it in the bill before the House Ag Committee. But I think what we're looking at with the uncertainty around tariffs and trade and markets and the price and input challenges, CRP had dual purposes. And so I think it's, as I'm trying to sort these things out and address the concerns that are real clear on all of our and on all of our minds right now, it's one of those times where this might be a policy. I think this is the kind of time where we should really think about how this policy can help us or help farmers.
When did CRP come into being?
Well, the version we have now came about in 85. It was probably the first version of it was 1956 in the Soil Bank, and then before that, kind of a version of it in 1936. But we do see it in this dual purpose role in times of natural resource challenges. So the Dust Bowl in the 30s, the droughts and dust problems in the 50s, and then the 80s where you had soil erosion, which also tend to coincide with economic crises and problems. So the Great Depression, the 50s price and cost squeezes, and the 80s economic crisis. So these things tend to work together, unfortunately, and that's where a program like CRP has this dual purpose. It helps preserve or reserve highly erodible or environmentally sensitive lands. Rent them out of production so they're not causing problems. But renting land out of production is also valuable in terms of, dealing with an oversupplied market or a series of market challenges. And so while and it's not a set aside program, I know it often gets thrown into that mix. It is a useful tool to address both soil erosion and natural resource concerns, as well as market uncertainty and challenges. And so the point of this article is, again, thinking through these issues. This would seem to be one of those times. I realize we're not in an 80s crisis or anything like that. I think we all want to avoid that. That would tell, the history would counsel us to get ahead of the problem, not wait for the problem to show up on our doorstep.
How big in 1985-86 was the CRP program expected to be?
So it was initially enacted with an acreage cap of 45 million acres. And right now, the acreage cap is an arbitrary 27 million acres. And we are right about the cap based on FSA's data reported.
That leaves a lot of room, particularly if this is an arbitrary cap for the expansion of the CRP. I suppose that's what you're really arguing for at this time.
Well, I mean, so I think one part of again, this is kind of brainstorming, right? Or brainstorming on paper, trying to think through these issues. So I don't know exactly what the policy, I'm not trying to say that it should be this or it should be that. I just think we need to think about how it could be helpful at this point in time. So I think CRP over time has maxed out. I think the most was ever enrolled was about 35 million acres. But what we also need to factor in is that CRP today is not what CRP was in the 80s. More than half of these acres are not that whole field enrollment taken out of production. Out of the 26 million acres in the program now, we're looking at over 8 million in continuous practices, which is really what we see predominantly in Illinois. So grass waterways, field buffers, those sort of things. Another 8 or 9 million acres is in the grasslands program, which can be used for grazing. And we're trying, we have issues with beef prices and rebuilding beef herds that could be useful there. And then just that last 7 or 8 million acres is in the whole field general enrollment. And so one of the things I think about, you could lift the cap, right? That's kind of a straightforward thing. Put more acres in, that can help on both sides of conservation and market challenges. But I also have been thinking about this cap and the arbitrary nature of it, and the concerns usually are that if you take whole fields out of production, it could impact, other aspects of the market and rural economies. But that same set of concerns doesn't apply to a continuous set of practices. So could we say, the cap only applies to the general whole field enrollment and that there isn't a cap on continuous? Because really, we can use grass waterways and buffers anywhere, right? And it doesn't take acres out of production that could be in a problematic way. It's helping production most likely.
Yeah, and for the taxpayer who's funding this, it feels as if that has a twofold effect. One, it's not taking land out of production. It is productive, but that might not be that productive. It's a smaller amount, and it has the added benefit that when these things are put in place, grass waterways and buffer zones and such, that they really are conservation and they clean up water.
Absolutely. Absolutely.
And so the taxpayer gets a twofold benefit out of it, and the producer, in my opinion, also gets a benefit from it.
Absolutely. In fact, I would say there's a threefold benefit here, because if this can be used effectively to avoid, further economic catastrophes for farmers, then the taxpayer isn't making bridge payments at $12 and $15 billion a clip. We won't see ARC and PLC payments as large as we're likely to see. So it can cut down the costs of all the assistance, this is one of those kind of, an ounce of prevention is better than a pound of cure. And so if we could prevent problems from getting worse than they are now, we don't have to pay for all the ad hoc and other assistance if we can try to use a program like this to manage the challenges and the uncertainties in front of us. So that's sort of the thinking here is, if the House is going to consider this legislation, now would be the time to maybe step back and say, okay, can CRP really, using its dual purposes, help farmers in this moment? And I think that's the sort of bottom line of this, or in this case, probably the top line with the title.
By this legislation, you mean the Farm Bill legislation before the House at the moment?
Well, again, I don't know if we can call it a farm bill, but it is certainly legislation authorizing programs that were previously in farm bills, and one of those is CRP. And so because they're considering CRP, this would seem to be a real opportune time to see if we can get an ounce of prevention to stave off what could be really problematic. And again, these aren't just payments and market problems. We end up losing farmers. We end up seeing farmers go out of business, lose their farms, lose their legacies on this, and it's tragic. that we don't need to go down this path again when we know what lies ahead if we don't address these problems.
Hey, thank you much.
Thank you, Todd.
That, of course, is Jonathan Coppess, agricultural economist from right here on the Urbana-Champaign campus of the University of Illinois. One more reminder that tomorrow we'll be hosting the All-Day Ag Outlook at the Beef House in Covington, Indiana. Walk-ins are welcome. The doors open at 7:30 a.m. Central Time. The program starts an hour later if you're in the Eastern Time Zone. The program starts at 9:30 in the Central Time Zone. That's at 8:30 a.m. We hope to see you there. Again, walk-ins are welcome, and because we had a glitch with our registration system, everything remains at $40, so go ahead and get yourself signed up. But do that before you make your way to Covington, Indiana, simply because once you get there, you're going to have to go ahead and fill out all the paperwork anyway, so you may as well do it in front of a computer that's easier to use on your own. The All-Day Ag Outlook is at the Beef House in Covington, Indiana tomorrow. That's exit 4 off Interstate 74 on the east side of the Illinois-Indiana state line. I'm coming to you today, of course, from the Landowners Conference right here at the iHotel in Champaign, Illinois. Up next, we'll talk about the weather forecast. Mark Russo is here now. He is with EverStream Analytics to help us take a look at the weather forecast. Hi, Mark. Thanks for being with us. What are you watching in the weather?
Well, Todd, we are watching the pattern here across the central U.S., which is anomalously warm over the next 10 days. Even some record-setting warm temperatures will be likely observed here across parts of the Midwest, the Delta, and Plain states as well as we go through, especially later on this week and into early next week. After that, temperatures do look to cool down, but just back down to more normal levels here. At this time, we're not seeing any kind of a return of extreme cold, at least directly into the central U.S., although there will be good cold still across Canada. Some of that does ooze into the northern plains middle of the month, but right now, no sign of that totally plunging southward and having any kind of a repeat of the large-scale anomalous cold of what we saw back just a few weeks ago. Also of note here, with especially the warmth the next 10 days, we are seeing an increase in precipitation across much of the central U.S. So as a result, we are seeing soil moisture improve across much of the Midwest Corn Belt and Delta growing areas. Also, the Midwest Soft Red Belt, the vast majority of acreage will receive meaningful rainfall. The one area, though, that does look to miss out with this general improved pattern is much of the Plains hard red winter wheat belt, which needs additional precipitation. And right now it's looking like the more favored areas for meaningful rainfall will be in eastern Kansas, eastern Oklahoma, and north central and northeast Texas versus the core winter wheat acreage in the western parts of those states.
That's Mark Russo. He's with EverStream Analytics. Do pick up, by the way, your tickets for tomorrow's All-Day Ag Outlook. Walk-ins are welcome, but it's just easier if you register online before you come, because that's what you're going to have to do if you show up at the door. Registration at willag.org, willag.org. I'll see you all tomorrow at the Beef House in Covington, Indiana. We're now joined by Ed Usset, agricultural economist at University of Minnesota. Hi, Ed. Thanks for being with us again. Let's start by taking up pricing opportunities for both old crop corn and soybeans. Have you been thinking about whether or not producers should finish out last year's crop and begin this year's crop?
I certainly am in the world of soybeans. And by the way, good morning. And I was at Commodity Classic, this big show just last week, and I spoke to 500 plus of my best friends one morning and talked about this. We're looking at, well, first of all, we had a wonderful rally in the world of cash soybean prices back in November, just 3 months ago. And about the time I started to talk about it, we were $1 to $1.25 off our harvest lows in mid-November. I started talking about it, and of course, it went away. And, it faded back to where we were, by early January. Well, we've got another rally. And in fact, right now, we're looking at, and forgive me, I talked southern Minnesota prices. I know they're a little better in Illinois, but we're talking a cash price of $10.50 a bushel, and in southern Minnesota, and that is the best we've seen since July of 2024. It's even a few cents better than that November rally. So even though, and I emphasize this down San Antonio, we don't typically make highs in February, and we could make the argument that we should wait a little longer. But the fact is, last year we did make highs in February. So, things happen. This is a great opportunity for old crop sales, which leads to new crop. I'm looking at the November contract, and by the way, it's a volatile day. We were up sharply, and now everything's trading lower. Not sharply lower, but lower. The November contract, as I talk, is at 11.26 a bushel. Todd, that's 50 cents better than we saw last year at its best before harvest. That's 50 cents better than we saw last year. You've got to take a hard look at pricing some new crop soybeans at that level and hope to heck you're wrong if you do it. Now, I got to tell you, I'm just not that enamored with corn prices. Yes, they are up modestly. We've got an opportunity, new crop December, somewhere around 465. Nice. Uh, uh, but man, I have a hard time with it. I guess if you screw up the courage, you get a little bit sold, because I like to remind people that we went sub $4, with each of the last two new crop December contracts in 2024 and 25. And yet I look at the May contract at 1162. Excuse me, that's the May soybean contract. I'm looking at the old crop and new crop corn contracts. They're off their lows, but I mean by 25 cents or something like that. It hasn't been a big rally. I'll do what I have to do in corn, but I'm not going to get overly aggressive. Soybeans, you got to step up and get something done.
Why?
A lot of it is policy driven. I'm not a policy expert. Policy can give, policy can take it away, and nothing's firm there. And again, with November contract, November 26 beans at 11 and a quarter, thereabouts, 50 cents better than the best we saw last year. You got to get something done, but you'll feel good. If it does go up, you'll be just fine.
Hey, thanks much. I appreciate it.
Okay, Todd. Take care.
You too. That's Ed Usset. He's an agricultural economist at the University of Minnesota. I'll see you tomorrow at the Beef House. Register today at willag.org. I'm Todd Gleason.